Welcome everyone to this episode of Finance and Investments Made Simple with Serari. With me today I have Montel, who's our in-house financial analyst, and Ryan, our in-house Gen Z and creative genius, who's curious to learn more about finance and investments and products. And today in particular, we'll be discussing bonds. What are they? This complex thing always floated around, the word bonds. We are going to try and make it simple, make it relatable, and show you what to look out for in case you want to get into the world of bonds. So karibu sana Ryan, karibu Montel. I'll hand over to Ryan. Tell us what you've heard about bonds and what sort of questions come to your mind when you hear of bonds.
Thank you very much, Dave. So as you know, people my age, we don't want to be tied down in life, stuck in an office your whole day, 9 to 5. We want to be free. We want to be out there. And the only way to do that is if the finances are lined up, right? And there's a lot of things we see out there. And one big thing when it comes to financial freedom, a lot of people mention are treasury bonds. So I'm curious, Montel, what are treasury bonds?
Thank you, Ryan. So I think I'll try to explain in simple terms what treasury bonds are. So see it as if that you are loaning the government. So the term treasury stands for the government treasury of your particular economy. So in this case, we're dealing with Kenyan treasury bonds. So a Kenyan treasury bond is essentially, whoever is buying a Kenyan treasury bond is essentially lending the government, and the government is paying back in terms of interest semi-annually. That is the structure of Kenyan treasury bonds. And essentially, we can use it as an investment vehicle. That is because the coupon earned is an income that you didn't have before. And also because it's a fixed income payment, which makes it a stable form of an investment. So in short terms, you're lending the government, and the government is paying you back interest plus your funds back.
That's fascinating. For once, I'm on the better side. I'm actually giving money to my government. Wow. Okay. So I've also heard a bit about treasury bills, and they're almost spoken hand in hand when people mention investing in the government. But what exactly is the difference?
Yeah, that's an amazing question. So in terms of how they work, essentially in both scenarios, you're lending your government, as you mentioned. However, the only difference is within the structure itself. So a treasury bill, essentially considered you're loaning the government for a period less than 1 year. And for a treasury bond, you are loaning the government for a period greater than 1 year. So essentially, that's the difference between T-bills and T-bonds in this context.
Interesting. So it's all a matter of duration. And I just want to understand. You did mention that at the end of the term, you get back a certain amount. How do these durations, or rather, how do these amounts vary in terms of the different durations, say in bills and bonds?
Yeah, so let me begin with the simplest, which is bills. So in duration, not all bills go for 1 year, or what you may call 364 days in how they're calculated. So we have T-bills that are called the 91-day T-bill. We have the 182-day T-bill, and we have the 364-day T-bill. So essentially, this means that the funds you're giving the government is discounted. So at the end of 91 days, you'll be getting your funds, and then you compound them by a certain interest rate that will be provided by the CBK. The same mathematical formula works for the 182-day. The only difference is that you will be having your funds coming after 182 days. And then for the 364, that is a whole year. But now in terms of T-bonds, we don't work with a discounted formula. So essentially, if you give the government 100,000 Kenya shillings, and they say it's paying 10% per annum, So that means that the semi-annual rate will be 5% of the 100,000, and it's semi-annual compounding. So at the end of 6 months, you should be able to get 5% of the funds that you did give the government. And then after another period of 6 months, you get another payment. So every 6 months, depending on the total time frame of the bond, if it's a 5-year bond, every 6 months for the next 5 years, you should be able to get coupon payments. That is a total of, in this case, 10 coupon payments. If it's a 10-year treasury bonds, you should be able to get 10 multiplied by 2, that is 20 payments over the span of 10 years. However, the only difference also comes within the taxes. So longer T-bonds, for longer T-bonds, you pay less withholding tax. So if a T-bond is greater than 10 years, so that's, you should always factor in the duration period. So if a T-bond goes for greater than 10 years, then you should be paying a withholding tax of 10%. If a T-bond is going for a period less than 10 years, the withholding tax will be 15%. And if you bought into a T-bond that is going for maybe 10 years, and after 5 years you're planning on selling this bond, then if you sell it at a profit, normally you are supposed to pay a capital gains tax. However, in the Kenyan tax code, the capital gains tax on sales within T-bonds are tax exempt, so you don't pay any capital gains tax. So essentially, that's the whole mechanisms in which they work.
Interesting. Capital gains are tax exempt. Wow. Okay. And you keep mentioning coupon rates and how there's these coupon payments that are made every so often. You've mentioned semi-annually, but just break that down a bit more for me.
Yeah, that's actually a very good question. So different bonds all over the world have different structures. This is a Kenyan structure thing. So in Kenya, T-bonds go for semi-annual. The payment is normally made semi-annually. So an annual payment means that you wait for a whole year to get your interest payment. So if it's 10% annual interest rate, then you should be able to get 10% of the value you put in, less the withholding tax. However, you don't file yourself for the withholding tax. Normally, the issuer is the one who will cut the tax and send your funds to KRA. You'll only get the net value. But essentially, an annual coupon means that you get your funds, the payments are made annually at the end of each year. Semi-annual coupons means that you get your funds at the end of half an year, so that's the semi part. You may get in terms of quarterly coupons, but this is not in the Kenyan scenario. But outside Kenya, you will find bonds that pay quarterly coupons. So this you get every quarter, you get a payment. And then you may have monthly coupon payments, so that means is monthly. So essentially, those are the different types of structures in terms of the periodic payment that a treasury bond can pay. So maybe, unless David has anything to add.
No, Montel, I think you've explained it beautifully. Maybe let's see how Ryan thinks and whether he has any more questions. Let's keep it going. I'm liking the conversation.
Yeah, great. I mean, I do agree with Dave. Your explanation is quite beautiful. So now that you've explained that the coupons, semi-annual payments, are the interest of my initial investment, what's the difference between the coupon rate and the yield to maturity then?
So maybe I can take this one. Yeah. So the difference between the coupon rate and the yield to maturity is, as Montel explained, the structure of a bond is that you invest a certain amount. Let's say you have, in this example, it will be a million shillings in your account, and you buy bonds worth 100 shillings, just as an example. So in total, you'll have bought, that's what, 10,000 bonds, each worth 100, and you'll be getting a coupon rate. So the coupon rate is the interest you receive, whether the payments you receive during, every 6 months or every 1 year during this period. So let's say maybe the coupon rate is around 10%. So you'll be receiving 100,000 every year if that's 100,000 every year if that's in annual payments, or if it's broken down into 2 payments, that will be estimatedly 50,000 per year. However, the yield to maturity is comes in because you don't just receive the coupon payments during the period. At the end of the period, you'll also receive your initial investment back. So in this case, will be the 1 million you invested. And the reason the coupon rate and the yield to maturity are different is because the buying price of the bond floats around in the financial markets. So today the bond will be selling for 100 shilling per bond, the bond note. Tomorrow it will be selling at 110, then it goes down to 90 shillings. These are wild figures, but just to make it for the sake of this example, if you were buying it at 110, for your million shillings you'll get less than 10,000 bonds, which means at the end of the period, when you redeem your 9,000 and something bonds, you're not getting at 100 shillings, you're getting 900 and something thousand. And the vice versa is also true. If the current price of the bond is 90 something shillings and you have your 1 million shillings, you'll get more bonds for 10,000 and something bonds, meaning at the end of the period, once you redeem the bond at par value, that's 100 shillings, you'll be getting more than the initial 1 million you invested. So when we're talking, just to make that, to try and make it a bit simpler, when we're talking about the yield to maturity, it is factoring in the current price, how many bonds you're getting. You'll still get the fixed coupon payments for per 100 shillings, but however, at the finalization of the bond, you will redeem the bond at 100 shillings, but that amount of money you'll get back will vary given the current price, or rather the number of bonds you bought at the current price. So the coupon rate, to make the long story short, is the fixed amount of payments you get during the period, but the yield to maturity factors in those payments together with your final redemption amount. I hope that makes it clearer, unless
yeah. I think what I've really picked is how current price really comes to play a role in this. So cool, the coupon rate is directly influenced by how much I've invested. And first of all, I thank you guys for your belief in me that I'll actually get to a point where I'll be investing 1 million. Guys, we'll get there. I'll get there. Anyway, definitely. But now when it comes to yield to maturity, if I happen to get a steal and buy a bond under 100, then my yield to maturity will be higher than somebody who paid above 100, right?
For the same exact bond at the same coupon rate, yes.
Yes. Okay. Brilliant. So now we have emphasized how important the current price is and how it affects your overall returns. But I just want to bring us back a bit, and I keep seeing different bond types. When I go to the CPK side looking at bonds and I see all these different bonds, explain to me, what are the different bonds?
So maybe I can go ahead. So within the Ferrari bond index, we are tracking all bonds within the Kenyan market. So within the Kenyan market, we'll have two different types of bonds. So we have the corporate bonds and we have the government bonds. So a corporate bond is a bond that is issued by an organization that is looking for funding. Maybe they want to fund a new project, and they don't have the funds, or maybe they want to use bonds as well as equity to fund the project they are working. So it depends. So in order to fund the project, they can launch a corporate bond via the Nairobi Securities Exchange, and thus investors can buy these bonds. Essentially, when we were explaining what treasury bonds are, we were saying that you're loaning the government. So in this case, you are loaning corporations, and they'll use these funds to do projects, and they'll pay you a coupon depending on how they'll structure it. The next type of bond we have displayed here is the infrastructure bonds and T-bonds. So they are all government bonds. However, they have some few differences. Number one, treasury bonds are used to fund day in, day out operations of the government. Within a financial year, the government may need to fund its budget, and thus we fund the budget through debt. And this is one of funding government operations, that is T-bonds and T-bills. But here this is just the bond index. Next we have is infrastructure bonds. So coming from the term infrastructure, so these bonds are used to fund infrastructure projects specifically. So this could be roads. So anything to do government projects, they can always launch an infrastructure bond. And the only difference between the two, again, in terms of structure, is that infrastructure bonds are tax exempt within the Kenyan economy. That's why they are also highly attractive within the Kenyan market. However, they're all T-bonds and infrastructure bonds are all posted or provided by the government. So I hope that answered your question.
Yes, it does. It's very interesting to see how the different bonds cater to different purposes and hence their names. But then there's also the aspect of risk. First of all, I've heard some people debating the different risk factor between the different bonds. First of all, could you explain what risk is and then explain how this touches on the different bonds or how it reflects on different bonds?
Yeah, maybe I can take this one. Just to say, risk in the general sense, even outside bonds, is the probability of you losing your money, losing your investment. So when we talk about risk in T-bonds, like Montel said, you're lending to a government or a corporation. That's a company, whether private or publicly listed. So it's the probability that you lend to, in this case, it will be the government or the corporation, and they don't pay you back, and they default on paying, the coupon rate or the final redemption amount. And when we talk about these bonds, the government and these corporations are raising quite large amounts. You're talking hundreds of millions, if not billions of Kenya shillings. And on the part of the corporation, on the part of the government, sometimes this comes with risk. So Montel said, for example, corporate bonds are used to fund corporate projects. And projects sometimes can go either way. They can work, they can maybe not work, depending on market factors or other factors involved. And in the government aspect as well, though rare, governments can also default. So when we talk about risk and the probability of default, so in general, it's accepted that lending to the government is quite secure and relatively low risk as compared to an individual corporation. And it is because the government, number one, this is a state. It is a nationwide institution, being significantly much larger than a single corporation, at least in most cases. And number one, they have access to printing money. So if, for example, you lend the government 1 million shillings, they'd be in the rather they have the capacity of printing that money and giving it back to you. Number two, also, governments have access to much larger credit and bailouts from different institutions as compared to a single corporation. So it's generally accepted that government bonds are safe and there's a very low probability that they'll default on this money that you're giving them. And for corporate bonds, not so much. Corporate bonds, this is an individual corporation. They are taking risk in the market. So there's significantly higher risk when lending to corporations as compared to lending to the government. I hope that answers your question on risk.
Yes, it does. And I think it's very interesting that, contrary to popular belief, my money is actually safe in the government's hands. Yeah. So you mentioned market factors, and I know one of the biggest things that investors have to keep their eyes on is inflation and interest rates. So how do these two come in when tracking a bond's performance?
Yeah, that's a very good question. So I'll start with the simplest one, which I think everyone is aware of, and that is inflation. So inflation essentially is the decline in purchasing power over a period of time. So it means that if goods used to cost 100 today, tomorrow the same goods may cost maybe 110. So that 10 shilling difference essentially means that the particular good is now more expensive than it was before. And thus, if your purchasing power, your buying power of the same good at 100 and now at 110, you're able to buy less of the same goods. In essence, that's it. That's how inflation works. In bonds, inflation also affects the net return of bonds. At the end of the day, when you give the government 100,000, let's say it was in January 2026, which is coming, and you decide to purchase a bond and you deposit 100,000 Kenya shillings. At the end of the period, maybe the bond gives you 12%. So you'll get 100, and so maybe let's use a simple case. In this case, maybe a T-bill. So at the end of 1 year, you expect 112 Kenya shillings, 112,000 Kenya shillings. So let's assume it's a tax-exempt infrastructure bond. So you expect 112K at the end of the period. However, inflation for the year, maybe for that year, was 4%. So your net return is 112K, but your purchasing power has actually gone down, because now you have, at December 2026, you have 112K, but you have the same purchasing power as you were in January, for 112 minus 4, which is 108,000. So your 112,000 can only purchase 108,000 worth of goods as of January of 2026. So inflation actually eats away your net return in real value. At the end of the day, the government will pay you, take out their withholding tax, and you'll have your net return. But in actual terms, in an economy, your purchasing power will be less. And that's why you always want to get a bond with a higher coupon rate. Of course, you have to look into other factors, but the higher the coupon rate, the better, because you'll be beating inflation more as compared to one who's earning a lower coupon rate. There's the other term that you mentioned, and it was in terms of how bonds are affected by interest rates. So this is one of the major factors that affects bonds. So in finance, we talk about the inverse relationship between interest rates and price. So when interest rates in an economy go up, the price of the bonds go down. And this is because when interest rates go up, the newly launched T-bonds will be going for very high interest rates. And thus the underlying bonds that are there in the market will be less attractive to investors, because these new bonds will be provided at high interest rates, and they can always sell and invest in high interest rate bonds. And this is one of the factors that causes bond prices to fall when interest rates go up. The same occurs in the inverse relationship. When interest rates go down, the price of the bond is normally expected to go up. So it works hand in hand in an inverse relationship. However, when you talk of interest rates, we should also cover interest rate risk. So David was able to explain about how interest rate risk works. So in bond terms, we normally call this, in simpler terms, bond duration. So it measures the sensitivity of a bond's price relative to changes in interest rates. And it's one of the key factors that you should be looking at when you're investing in bonds, that inverse relationship between interest rates and also bond prices. So I hope I answered your question.
Yes, you definitely have. Now, as a young investor or just an investor in general, we've spoken about a lot of things, a lot of metrics to keep in mind: yield to maturity, current price, coupon rate, the risk, the type of bond. There is so much to hold and look for. Is there a tool that can simply guide me through all these things and easily measure and rank them for me?
Yeah, and I mean that's where Serari we come in and try to make all these factors as simple as possible for people outside the financial world to come in and just begin investing on their own, or even if they're using a financial institution, an intermediary, or an advisor, they are able also to understand what's going on. So here on the Serari group.com website, when you go to the bond page, we have done our best to try and describe some of these relationships that we are talking with you about or rather trying to simplify some of these decisions. So when you come here, we can see there's a column describing, number one, the bond name. This is, whether it's a Kenya government bond or their corporate bonds, with their own names given by different companies. So there's EABL, there's Family Bank, and the rest. And then there's the ISIN, which is the ID number basically. So this is how you'd be able to identify the specific bond in the market when you go to buy from a brokerage or wherever you're buying it from. Then the issue date, this is when the bond was issued, and also the type of bond, whether it's an infrastructure bond with no taxes as Montel described, or an ordinary treasury bond. Then there's the risk index, whether it's government, hence low risk, or corporate bond with higher risk than government. Then we talk about the coupon rate that's been floated. So the coupon rate is the amount you should expect on the number of bonds you purchase. So sorry, I lost my train of thought a bit there, but yeah, just talking about the coupon rate. Yeah, the coupon rate, these are the periodic payments in Kenya. They tend to be every 6 months that this is paid out. And then we have the yield to maturity, which we talked about is your sort of real return, but using that word very loosely. Real return also should factor in inflation, which is not factored in by yield to maturity. But just, when we talk about yield to maturity, we're talking about not just the coupon rate, but also the redemption amount you'll get. So your sort of final return, I think that will be a more proper word to use, your final return, assuming you hold the bond all the way till the end. Then we have the current price of the bond as of today. This gets updated on a daily basis. Then we talk about, let me leave the bond ranking index for just a second, but then go about the maturity date. So this is when the bond is ending and you'll get back your final amount. So if you invested whatever amount you invested, in Rand's example will be 1 million, at the end of the period, that's in 2035, for example, that's in 10 years, you should expect a large payment back, or longer periods for further maturity dates and shorter periods for shorter maturity dates. And then this is the minimum investment if you're going to invest directly with the CBK through the CDS Though platform, or M-Akiba in the M-Pesa platform. So what we have done at Serari is try and rank the bonds, try and keep these many complex factors. We talked about yield to maturity, we talked about price, we talked about risk. So we've tried and put this in a simple index. This is not final. This is not everything that goes into a bond's factors, but trying to make it to cover as many things as we can. So generally, when you're buying a bond, you want to buy it at a higher coupon rate, because this will mean that you get more bang for your buck, more payments during the periodic payments. And also similarly, you want a higher yield to maturity, meaning your money has a higher return on investment. You are also looking at low risk. You generally want lower risk. You don't want to risk your money as much. And also, just like anything else out there, you want to buy cheaply. And if you're going to sell it at a higher price. So you want, just to summarize all that, you want as higher coupon rate as possible, a higher yield to maturity as possible. You want to buy at a low risk, and you want to buy at a low price. So this is what goes into our Serari bond ranking index, trying and give some indication to anyone looking to buy bonds, that given these 4 factors, we believe that this can give you an indication of where to start in terms of looking at buying your next bond. So this tells us, if you look at all these factors, this bond comes out on top, followed by this one and the next and the next, and so on and so forth, all the way to some we've classified as higher risk. And it's because some of those factors don't work in their favor. You'll notice a lot of these tend to be higher risk bonds, corporate bonds as compared to government bonds. But for the government bonds that are here, you'll notice their YTM is low, while their price is also high. So this is a tool, as you mentioned. What tool can someone start from or begin looking at to decide on which bond to buy? And Serari will be a great stop, or rather a great start, to begin taking into account these factors. But the reason we said they're not final, different people have different investment horizons. Right now it's 2025. Someone could be looking at these 2 bonds are very similar in terms of their ranking index, and you can see their prices are almost the same. Their YTM is not far apart, and they're both low risk. But different investors have different horizons. So someone could be looking at 10 years from now in 2035, or 14 years from now in 2039, and say, I want to invest for the long term. This 1 million that I'm going to put in, this 2 million that I'm going to put in, I don't need it for the next 14 years, give or take. So they put it into a longer term bond. Someone might want the money back in 8 years. Let me use that as an example. So they'd come to, for example, this bond. It's lower than the others in the index, but it fits an investor who is looking at an 8-year horizon compared to 10 years or 15 years. Some of them are going up to, for example, this one you're talking about close to 17 years, 18 years from now, give or take. So this is a great place to start, and Serari try and simplify things and democratize some of these complex products and investments. But yeah, with the heavy caveat that this is just somewhere to start looking at the bonds. And also, if you have an advisor, they can give you now more details on the bonds. Prices are constantly changing every day. But I hope it will be a helpful tool to yourself, Ryan, and to others out there who are looking at going and starting to invest in bonds.
Thank you so much, Dave. And I personally think this is a great tool because it easily just wraps up all the key pillars of investing in T-bonds. And then the rest is just up to my preference, like you said, how long I want it to go for, maybe even the type of bond as well. So yeah, much appreciated, guys. And I think it's great that this tool is free to access for everyone. All they need to do is go to the Serari Treasury bond page and they'll easily find this index. They can take a look through it and anyone can become an investor. Actually, a well-informed investor thanks to this index. So thank you so much for your time, guys. And I think I'm ready to invest in some Treasury bonds.
Awesome. Thank you so much, Ryan. In Serari, try and give as much information about finances and investments for everyone. Doesn't matter. You've seen we can begin with as little as 3,000 Kenya shillings or 50,000. So try and making not just the bond themselves, but information about the bonds accessible. So there are some great articles curated by Montel and other financial analysts at Serari. Jump in here, take a read, take a look. In case you have any more questions, feel free to reach out to us via info@serarigroup.com. Our webpage is serarigroup.com, and when you click on the drop down that says compare African economies and financial products, there's a plethora of financial investments and products and information and very great visualizations curated for you for free to come in here and begin learning more, and there's great material for everyone who is looking at this, including Ryan, who is soon to get 1 million and throw into bonds, and he'll update us on how this is going in the very So thank you so much. Montel, any final words for our viewers and for Ryan?
So in terms of covering the whole context, I think Ryan is well equipped to invest his 1M. So I think we should be looking to contact Ryan in 6 months, as we mentioned. So give or take. So Ryan, I'm hoping in 6 months we'll be able to find you somewhere. Other than that, I think it was a very fruitful conversation. This is a conversation that talks about how T-bonds work. It is quite important for someone who is new to T-bonds. So you don't need to figure out how the math works, how the YTM works and all that. We've made it simpler for you. Just go to the bond ranking index. We have color coded. So we have green, which is what we do state that is good in terms of investment grading. We have yellow, which you can also consider. Under the reds, that means that carries a very high risk. So we've made it simple for you, for all investors who are watching this. And so looking forward to happy investing within the Kenyan economy.
Awesome. Thank you so much, Montel. Thank you, everyone. See you on the next episode of Made Simple, Finance and Investments Made Simple with Serari. Cheers.